Here's 8 things that I wish I'd known when I started investing all those years ago. And honestly, if you can know them now, before you get started investing, I really think they can make you a better investor for the long run. Up first, I wish I knew about index funds. Now, they're probably something I talk about the most on this channel. And as a beginner, you're probably sick of hearing about them all the time on YouTube. You might think they get all repetitive because everyone just keeps going on about them, but they are so important. And when I first started investing, I had no idea they even existed. I understood the concept of a fund, that lots of people put money together and that fund would then get invested, but I always assumed that had to be done by some expensive money manager who kind of knew what they were doing to, of course, try and get those nice good returns for everyone. But in reality, the more and more I learn and the more I realize that actually these index funds, these passive funds that don't need any active managers could beat the market, was the kind of first time that I got that kind of switch flicked in my brain. I realized actually this is where I should be investing my money. But I didn't know that at the start, so I ended up investing in all kinds of weird and wonderful things, different kind of active funds and different stocks and shares, and that is a massive regret. Another thing too with index funds is they're just so easy. You don't have to worry about going through financial statements or due diligence or trying to figure out if a company's going to be around for the next 10 or 20 years. The whole idea of a passive index fund is it's just sorted out by market weight. So how big the company is the larger percentage that it takes up in an index. And the most famous one that we always talk about is the S&P 500. So the largest companies, Apple being the largest company in the world, takes up that top spot and takes up the largest percentage. Over the next decade, over the next 20 years, as those different companies change and they change in their market position, they will change their index, but you just leave the index to sort that out for you. And really, that is a huge weight off your shoulders. Now, the second thing that I wish I knew more about when I started was I wish I knew about the tax protected or tax advantage investing account. Generally, I guess I wish I just knew about all the different kinds of investing accounts. But I remember when I first started and opened up my account on one of the brokers, the first thing I looked at was I just thought, oh, well, I just need a general investing account or a trading account, a fund and share account, whatever you want to call it. And that is what I ended up going for. When I saw words like stocks and shares ISA or individual savings account, I assumed that that would kind of lock your money away or there'd be some kind of restrictions. I kind of got my head around thinking, oh, you must have to lock your money away for a year or two before you could see it. I don't want any of that. I want to make sure I get into this whole trading thing. It was actually only a few years ago where I finally got all my money really into those ISAs here in the UK, those tax protected accounts, those individual savings accounts. Now the different tax protected accounts will vary depending on where you live in the world, but here in the UK we've got the individual savings accounts, the ISAs. You've got the cash ISA, you've got your stocks and shares ISA, your lifetime ISA, and then your innovative finance ISA as well, which is £20,000 a year tax-free that you can invest into and spread that across all of those different accounts, which is a huge amount of money when you think about it. If you compare that to the US, for example, the Roth IRA, what's that? Around $6,500, so probably close to £5,000 invested they could do tax-free, and we get £20,000 a year tax-free. Now, it doesn't necessarily matter in the short term, but if you build up that account over the long term, and you get lots of dividends and you make some big gains, having that tax-free is a huge benefit, so I wish I'd known that sooner. Now, if you are looking to get yourself started investing, I always keep links in the description below of my preferred brokers and platforms that I use, and you can get some free shares or some free money for signing up, and once you work your way through that process, so don't forget, check those out later. In 3, and this all kind of links together really, is I wish I just investigated the topic more or either bought some books or an online course or really just try to understand what investing was in the first place. It's funny because investing is like one of those only areas where you don't get taught at school, you don't get taught by your parents unless you're really lucky. Most of your friends also won't have a clue, again, unless you're really lucky in those kind of circles. So you're left to fend for yourself and try and figure out how this whole investing thing works. And you assume either that it's a whole scam or you assume that you have to be some kind of smart trader or something you see on Wolf of Wall Street to actually invest your money, when really that couldn't be much further from the truth. In reality, you do need to wrap your head around a few basic concepts, and there's loads of information out there, you just need to know where to get it. And it always sounds really interesting and easy, for example, to say, oh, you just go and buy some books. Well, which books do you buy? Now, thankfully, I've read quite a few books on investing since I've ended up getting started and really getting into the weeds. You may know one of my popular videos on this channel that many of you would have seen. I'll put that up on screen now, where I went through all of the books that I've been reading around investing, business, and finance. Now, some of the recommendations from that one, especially if you are from the UK, I would definitely pick up a book called Money, which is a really good one. And also, don't forget, a fellow finance creator here on YouTube, it's Pete Matthew, who's got a really good book here, and he is a chartered financial planner as well, who actually has professional qualifications, unlike myself, who is not a professional qualified advisor. So as much as it really is important to get yourself started early in investing, and you want to be in the market for as long as possible, I do think you should take a little bit of time, just a couple of weeks, to actually read about everything that goes on in your specific country. They can be books about generally kind of investing terms, or they can be books specifically around like the accounts we have here in the UK. Pick a few of those up, but I'll leave a link in the description as well to my book video if you want to go and check that one out later. In 4, I wish I'd known how hard it could be. Now, I'm not talking about physically hard, I'm more really talking about here the mental aspects of investing. Now, I remember when I got started investing, I'm sure many of you are going to relate to this, but you check your account every single day, you're seeing if the market's going up and down, you're looking at news articles, you're thinking, oh my God, the market's crashing, it's gone down 0.5% or 1%, and one day, everything's really bad, just your luck, trust you to get started investing. And that was my exact mindset as well. And I think the only way to kind of cure that is really by doing your research in the first place, and goes back and links to everything else I've said so far in this video, is that really you kind of need to know what you're doing and also realize that this journey is going to have lots and lots of ups and downs. One of the memories I have, I think it was around 2015, 2016, and there was quite a bit of a dip. I think it was the tech sector, it might have generally been the markets, but I think it was around kind of the Christmassy January time, and I remember looking at my accounts thinking, this is just awful. You know, I've just timed this really badly, or the stocks I've picked are just terrible. I think lots of them were kind of in that big tech sector. Now in hindsight, as we know now, holding through that over the long term would have done very well. But at the time I was doubting myself and really thinking, what the hell am I doing? I may as well just sell everything. Now another point I would make, I guess, ties back to what I was saying about index funds earlier, and you kind of, if you only went down the index fund route and went down the passive route and just got used to consistently doing that every single month and investing no matter what, that would get easier and easier over time. The problem is if you kind of time the market or jump in and out is when you really start to get those issues. So although it's difficult because everyone can tell you something's hard, it's like saying, go and run a marathon, you think, well, it'll be really easy. But actually, in reality, when you try it, it's really, really difficult. Now, the only way to get good at it is, unfortunately, really being in the game yourself. So it's almost just like telling someone, you have to be aware of it. You won't really know how you're going to feel until it does happen to you, but just be aware that you will have these big up and downs, especially on the mental side. So you kind of just have to get used to it. Next up, I wish I had just avoided trying to pick stocks and trying to time the market. This lesson's really funny because I swear this lesson, no matter how many times you tell people, this is something that I feel like each individual investor has to learn themselves, because no matter how many times you tell someone, don't try and time the market, don't buy these certain stocks, at some point in your investing career, I guarantee it, whether you want to admit to yourself or not, that you've gone in with FOMO, you've bought a stock because you thought it was going to go up or you thought you were going to lose out. You've definitely made a very, very poor decision, whatever that could be. There could be a million and different reasons why you've made that decision. Now, sure, you might get lucky, and there is a good feeling if you get in at the bottom or you end up getting a really good buy price on a stock and all you see in your account is green. But there will come a time when that feeling will go and disappear. And the problem is, if you did get it right a couple of times, your kind of confidence level gets way above your competence level, and nobody can time the market. I don't know how many times that we had to tell ourselves this, and all the world's greatest investors tell us this specifically, yet we suddenly think that we are going to be the ones to be able to beat it. So you absolutely can't do this, but I don't really know how to explain the lesson unless you try it for yourself and make those mistakes. But hopefully you can make those mistakes and they don't cost you as much money, and you can keep that cost down to a minimum. And again, this all comes back to now what I do as an investor. Rather than going crazily, picking lots of different stocks and having weightings which are really, really crazy, is I do stick to the majority of my investing. It's all in passive index funds. And on the side, I do have a small selection of stocks that are our individual stock picks, but the majority of my money and the majority of my investing will always remain in low-cost passive index funds. And I intend to just keep dollar cost averaging or putting those monthly deposits into my account, especially using a stocks and shares ISA every single month for years and years and years. And that takes so much stress out of it. Now, I know you've heard this one before and it's a bit of a cliche, but oh my God, I wish I'd started sooner. And yeah, I'm sure there'll be people in the comment section who've literally invested at the worst peak of the market in 2021 and have just had a terrible ride through 2022. And maybe they're only just starting to recover in 2023. Thinking you've made the worst possible timing. But the truth is, as a really long-term investor, nothing beats timing the market versus trying to time the market, as we spoke about on our last points. Really, what I would have liked to do is, even with small amounts of money, is just get used to that fact that every single month or every single couple of weeks, whenever you get paid, to be able to make that investment and just treat investing like you would do your phone bill, paying the gas bill, paying your TV license, or whatever you do, is just make that really easy and make that simple process. I'd almost prefer to start with smaller amounts of money just so I can get used to it and then build up to more and more and more as I get comfortable. But oh my God, don't we all wish that we started sooner? Now, I know part of that is also hindsight because we're looking now at the stock market thinking, you know, 10 years ago, the stock market was in a very bad place. And if it was the other way, we would probably have some other regrets. But generally, as a long-term investor, we do put ourselves in a much better position to start early and do that dollar cost averaging as often and as frequent as we can, because that is a great way to make sure that we get an average price as that market generally trends upwards. Let's run a quick example and say you put in £200 a month from age 25 up until 60, and then also someone who puts in £200 a month again from 35 till 60 with the same percentage returns. And I'll put up on screen for you now just the kind of differences we're talking about. And just think here as well, this isn't even increasing that £200 a month with inflation. This is just £200 a month throughout your entire investing career, as actually you should have more money as you get a bit older. Point 7, and this is such an important one that really I only got my head around over the last couple of years, but it really is how important it is. I wish I'd known to keep my fees and charges low. Now, when you're investing, you will have lots of different fees and charges. You can't avoid that. That's kind of price of entry. You have to get some kind of fees and charges that are going to get on your account. Now, the first set of kind of fees that you need to look at are the ones that are going to come from your platform or the app you're going to use. So you need to work out, and these are normally charged kind of as a percentage of how much money you have in your account. But some apps these days are also charging a monthly fee, just no matter how much that you have invested. So that's one thing to keep an eye on. But then also, depending on what you invest in, you need to look at the transaction fees and the different costs involved in that as well. So for example, if you are investing in mutual funds or ETFs, especially the fancier ones, you need to look for that total expense ratio that you might see on the fact sheet. So for example, a low-cost index fund, one like VUSA, which is a Vanguard ETF, here in the UK that has 0.07% fee. But then other examples might be some fancy mutual fund or some fancy ETF, which might have 0.75%. That is a huge difference in fees, and really the lower you can make them over the long term, they can have a huge impact on what you actually end up with as an investor. And let me just show you on screen now potentially exactly what I'm talking about. So let's say you did invest £200 a month for 30 years with a 10% return against someone who also put in £200 a month for 20 years, but they got 1.5% less because of all the different fees and charges they're experiencing. Have a look at these two numbers now. So we're looking here at £100,000 in fees across 30 years, because not only have you got to look at the fees, but you've got to look at the compounding effects too. So taking off the old 10, 20, £100 here or there per year, that adds up over the years, because that in money, rather than being sat there invested, just ends up going to your broker. So your broker and your platform and all the different people involved are going to be making £100,000 off you here. So really focus on those fees. And I guess a big way to do that, look back to the points earlier, low cost index funds, and then making sure that you use the right platforms to keep an eye on your costs. Again, the ones I use tend to be very low cost and also free. Now, last point, but absolutely by no means least, is number 8. I wish I'd known about pensions. It sounds so boring. It's probably the least exciting topic. Everyone wants to get rich quick, but pensions can be extremely powerful. Just think right now, as an employee, you will have a pension with your workplace. Do you even pay attention to it? Most people will probably say no. Do you have any idea what's going on with it? Most people will probably say no. Do you have any idea of the potential growth or the amount of money that potentially you're leaving on the table? Again, most people are going to say no to that one. So go to your employer, go to HR, go to accounts, go to whoever it is. Make sure you understand how your pension works. Could you contribute more each month? Will your employer match your contribution more? This is all free money from your employer that will go in tax-free into your pension. Now, there is a downside that the pension can only be accessed during your pensionable years later on in life, but this money will compound for decades, and it is free money. You may as well take advantage of it. Although things like stocks and shares ISAs are really good, this is money which has already been taxed and you're putting in yourself. But really, what beats putting £100 in and getting your employer to also put another £100 in? That's an instant doubling of your money. Now, also outside of that, the limits for pensions are huge as well. You can put in up to £60,000 per year, and you can even go back several years, I believe, at the moment. So if you haven't contributed and you earn quite a lot of money, there's a huge amount of money that you can put into pensions too. So make sure you understand that. You can't touch it until later, and it will be taxed on the way out. So there are pros and cons that you have to figure out, but still, don't sleep on pensions. Anyway, I hope that was useful. As always, leave your tips below in the comment section below. I'll see you in the next video. As always, happy investing.